Good afternoon, or possibly good morning, wherever you're listening to us from today. My name is Scott Maurer. I'm the Director of Business Development and VP of Sales here at Advanta IRA. Looking forward to another great webinar. We have a great guest on today who's going to talk about multiplying your money. So a lot of times in the webinars that we have here at Advanta, we get more specific on certain investments and a little in other more intricate details, I guess is what I was trying to say, about specific investments. We're going to take a little bit broader look today with our guests and really talk about multiplying your money, whether it's in an IRA or not. What you're going to learn today should be helpful for you in that aspect of your financial freedom and your wealth. Again, my name is Scott Maurer. I've been with Advanta IRA for a number of years now, hold a number of different roles during the company, but I've spent the last decade or so really focused on the education of an aspect of teaching people about self-directed IRA accounts and the different things that you can do with your retirement accounts, whether it's real estate investing, private note investing, investing in startup companies, things of that nature as well. And I'm actually happy our guest that we're having on today specializes in some commercial and multifamily real estate, which is something I've really spent a lot more time over the last 4 or 5 years developing those contacts and working with people for those investments. If you have any questions during our webinar today, don't hesitate to type those questions into the question box on your screen. I'll make sure to monitor those, get those answered by myself or our guest host, guest presenter today. But if you also can reach me at the number on this screen or my email address if you have any other questions after the webinar or something that you want just to discuss. Personally, I'm always available to have those conversations with you and walk through potential scenarios and investments you're thinking about making with your IRA account. Just a quick note about Advanta IRA, if any of you are unfamiliar with our company. We've been in the industry almost 20 years. The only thing that we do at Advanta is administer self-directed IRA accounts. I'll talk about what that means in just a moment. But we have over $2.5 billion in assets under management. We have over 11,000 active clients who are investing in some of the investments that I'll talk about in just a moment. But we do kind of set ourselves apart in our industry in 2 ways. One is that we all Advanta clients get a dedicated account manager, one point of contact who can help them with anything they need regarding their account, making their investments, and also really our educational aspect. So the webinars that we do 1 to 2 webinars a week. We do live events from time to time, and we certainly are always available again to participate in other people's podcasts, webinars, or even getting on a phone one-on-one or on a conference call to explain more about self-directed IRAs. So be on the lookout for our webinars if you're new to Advanta or new to the emails that you get. Again, 1 to 2 webinars typically a week. We also will be reintroducing our Pitch, Promote, and Prosper event coming up in another month or 2. At summer ended, that was an online networking event that we took a little bit of a hiatus for at the beginning of the summer, but we'll be bringing that back as well. And that's an event that allows you to actually go out there and say what it is that you're looking to invest in, what you're looking to sell, and kind of have that online networking forum. So that'll be on the lookout for that email coming out to announce when we're bringing that event back. Again, for those of you who are unfamiliar with self-directed IRAs, really that's what self-directed retirement account means simply is that you have the ability to invest in assets that you understand and that you can control. Most retirement accounts, most custodians limit you to investing in assets that they sell. And those assets typically are publicly traded mutual funds, stocks, bonds, and just other publicly traded securities. But the IRS rules allow you to invest in a number of different type of investments, all what we call alternative assets, where you can use these different investments to help grow your retirement account, build your wealth, and really invest outside of the stock market. And so a self-directed IRA is really where you're choosing the actual investment type, not choosing from a number of different investments that are allowed by your specific custodian. People typically choose to self-direct for a couple of different reasons. For one, for some, it's the tax benefits. When you use your IRA to invest in any investment, the rents, the dividends, the profits that you might make from that investment come back to your IRA, either tax deferred or possibly tax free, depending on the type of IRA account that you have. So if you're looking to make an investment and you do not want any tax consequences to yourself personally, you can use your IRA to make that investment and have and not have to worry about what the tax impact will be to you. It's simply money going back into your IRA. As I mentioned a moment ago, other individuals are have stock market fatigue or would like to at least get some diversity within their retirement account and get some of their money out of the publicly traded markets and into something they can control. But for a lot of people, they're choosing the self-direct simply because that's where the cash is. So if they come across an investment opportunity, it could be, again, multifamily syndication, could be a friend's startup company, could be a private loan that they want to make. The IRA has the cash that they can then use to make the investment. They may not have it in their personal savings account or not want to part with their money in that account, but they can use their IRA, use that old 401k to make that particular investment. Most people are unaware that you can self-direct your account. Again, as I mentioned, a lot of retirement accounts are held with banks and brokerage firms who offer you only the products that they sell. So they're not going to tell you that you have other options. And I have the analogy here for fast food. If you go to a fast food restaurant today for lunch, they're not going to tell you about other things that you could have for lunch that day if you just simply went to a different place for lunch. And so that's kind of one of the reasons, again, why most people don't know about self-directed IRAs is that they're not being told by their current broker or their current administrator. They have to look outside the box. Maybe a friend tells them about it, their CPA, maybe the investment provider themselves lets them know that they have that option. Again, so IRS regulations allow you to hold a very broad range of investments. The only restrictions, you cannot buy life insurance and you cannot buy collectibles. But not every custodian is going to be required to hold every single asset. So that's why our companies exist to hold these, we call, like I said, truly alternative assets. For people who are looking to raise capital, I think IRAs and retirement funds are a good source for a couple of different reasons. One, you can tap into your existing investor database and simply go back to some of your existing investors and say, hey, if you have another project coming up, here's a different way that you could invest. If you'd like what happened in the first deal that you're invested in, here's another way to invest using your IRA and to these other deals that we have coming up. So if you're raising capital, you don't necessarily have to go out and find new investors. You can use your existing investors and show them a different way to use some of their capital. Again, people are looking for alternatives. What can I do outside of the stock market? What are other investments I can make? And so if you can show them a way they could invest with you and use your IRA and get it out of the stock market at the same time, that can be very attractive. Currently there are trillions of dollars in retirement accounts. The money's in IRAs and 401ks, the last estimate is over or around $37.5 trillion. And probably 4 to 5% of that money is actually being self-directed. So you certainly have the ability to raise quite a bit of money from IRAs and from 401ks. And I think from the other aspect, a lot of individuals not expecting to use their funds in really for 5 to 10 years within an IRA account at most, maybe even much longer than that. They're not typically, they're not typically looking to use that money until they hit retirement age. And so if they're looking at an investment where maybe their funds are going to be locked up for 2, 3, 5 years, maybe even a little bit longer, they don't want to touch their personal savings accounts. They would rather, use IRA funds. They'd rather use old 401ks because their rainy day funds, their savings accounts are there for other purposes. They're for emergencies. But their IRAs or 401ks, that's money that they know is going to be locked up for a while. And so I think if you're looking to raise capital, showing someone how they can use their IRA as opposed to their savings account really can kind of entice them of a different way to invest and not worry about locking their money up long term. As far as some of the different investment types, like I said, we see a lot of different types of real estate, whether it's a rehab, whether it's a long-term rental property, people investing in multifamily syndications and in commercial real estate. You can do joint ventures, your IRA putting up some of the cash along somebody else's know-how or expertise. I mentioned you can invest in startup companies that are private, other types of private stock offerings. Again, there's a lot of different things you can do with a self-directed IRA. The only restriction is that you cannot invest in life insurance and you cannot invest in collectibles. Again, I mentioned that a moment ago. Those are the only two prohibited assets that you can hold within a self-directed IRA. And again, you can self-direct any type of IRA account. If you have a traditional or a rollover IRA, a Roth IRA, a SEP IRA, a simple IRA, all of those can be self-directed if you just take the steps to open up an account and transfer funds from those existing accounts. Those transfers happen tax-free. Also, if you have those old employer plans, like old 401ks, 403b plans, those monies can also be moved over into a self-directed IRA. I don't want to take up too much time going through those basics, but if you have questions on the specific types of IRAs and what can be done, please don't hesitate to reach out to me. The last slide I have before we'll bring on our guest presenter here in a minute is really, I think it helps people sometimes really understand what kind of investor they want to be. Are you somebody who's more active and you want to have more control, make the decisions? You might tend to look at rental properties or rehabs or doing wholesaling of real estate where you are, your time is required. You are going to have to make those decisions. And so that some people tend and want to be in that aspect of it. But again, the downside is you're going to have to spend a lot more of your time and be responsible for those details when you're being an active investor. Maybe there's a bigger upside to you from the investment. And then you also have people who are looking to be more passive. Maybe they have a W-2 job. They don't have the time to dedicate to going out and finding real estate, but they're happy to invest in other people's syndications or do a private loan from their IRA to that other capital raiser or that other investor, where you don't have to commit as much of your time. You're not bothered by the day-to-day ins and outs of the investment itself. But in your contrast, you're going to give up some of that control. So this is a slide I like to include in some of the presentations just for people who are getting started. I think this can kind of help you have that analysis. Do I have the time to be more active? Do I want to be more active, or do I want to be more of a passive investor and kind of sit back and let someone else do kind of some of the hard work in the investment? So that's all I am to talk about with self-directed IRAs today. Again, happy to field questions in the chat box here on the screen. Happy for you to reach out to me later as well. With my phone number and email, I'll have it up again at the end of the presentation. But at this time, I'd like to bring in our guest presenter. He's going to talk about multiplying your money. His name is Ellis Hammond. He is the CEO of Symphony Capital Group. During his time there, he has acquired over $150 million in commercial real estate since 2021. He has a personal mission. He really wants to help individuals build wealth, increase their impact through real estate investing. You'll have his contact information on this slide, but we're going to have some more contact information from him during his presentation as well. But at this time, I want to bring Ellis on. Ellis, I'm going to turn it over to you, allow you to share your screen, share your slides, and again, just encourage anyone who's listening live to the presentation today, type your questions into the chat box on the screen. I'll make sure to monitor those as we go along. But Ellis, at this point, I'll turn it over to you. How are you doing today?
Hey, Scott, great to be here. Grateful to be here. Really appreciate all your work at Advanta. I know a lot of our clients, I send everybody to Scott, because I know on my end as the operator, I want to make sure we're working with a group that's not asking me a whole lot of questions, and then my investors don't know, all the paperwork stuff. So, man, you guys take care of it all from start to finish, and so it's been a really good relationship. So I'm excited to just be able to give back to your community today. And I will turn my camera on just to say hello to everybody. So anyways, glad to be here, man. Thanks for all the work and partnership over the last couple of years, and appreciate you having me on.
Sure, no problem, Ellis. Happy to do so. Yeah, just I'm not seeing your slides quite yet. I'm seeing just a screen with.
Sure. Yeah, so we'll get this.
We'll get those up
right now and ready to rock.
Yep, there you go. So I'm gonna put myself on mute. I'll let you take it from here. And like I said, I'll monitor the questions. And again, anyone listening live, get those questions asked into the chat box and take it away.
Okay, man. Welcome everybody. I really am excited about this presentation. I think it'll be very different from what maybe you've seen in the past. We're not talking about a specific asset. I want to talk about this right here, why this matters, the multiplication of money. And I feel like there's a lot of talk about how to make money, maybe even how to protect money, but very few. And I know because I'm an entrepreneur myself, and I'm in a lot of entrepreneurial circles, or I'm in a lot of business professional circles, that People know how to make money. Maybe you're in a profession today that knows how to make money, but very, very few people, even the most successful people, actually know the art of multiplying money. And so I do believe that multiplication of money is the number one factor you must know to build serious wealth. And the reason that is because it's simply no longer enough to know how to make it. Like if you know how to make money, but you don't have a clear strategy on how to create 2, 5x, even 10x returns, you're going to be in trouble. I mean, and I say, you know, the proof. I mean, you just look at some of the highest paid places today: doctors, attorneys, you know, the physician route. I mean, I know a lot of them who get, you know, further on in their career and end up frustrated because they're still having to work in order to maintain their lifestyle, right? And so even if you're in a profession like that, where you do make solid income, if you don't know how to multiply that income into retirement, it is going to be an issue. So I want to just help you with that today. And so I would love to see some interaction in the chat here. And I just would, you know, let me ask you a simple question today. And if you would entertain me by just interacting with me on the chat today. This is live, and so I can't see what you're saying. I'm reading the comments. And so are you satisfied with your results? Are you satisfied with your results? I'm assuming that if you're here this morning, you're here this afternoon, that it's morning on the West Coast, Scott's on the East Coast, I'm in San Diego, California. The reality is you're not, you know, and even if you've had success, you want more. And so will you agree with me that if you want radically different results from that of your peers, you will have to take radically different actions? I just want to make sure I'm talking to the right crowd today, because I feel, and I think we all realize this, that if we just continue to do the same things that everyone around us is doing, that the traditional financial wealth kind of system education is teaching us, what we're going to end up with is average results or below average results in this day and age. And so let me tell you a little bit about myself before we get into this presentation today. I am a former pastor turned entrepreneur and investor. I run the largest faith-based mastermind organization for real estate investors and CEOs called Kingdom REI, where we teach and train people how to actively become a real estate investor. I'm the co-founder and managing principal of Symphony Capital Group. So this is our acquisition firm. We've currently partnered with over 100 investors and own and manage more than $150 million of multifamily real estate since around 2020 is when our firm began. Been investing before that, but really began to syndicate projects and raise outside equity then. But here is my first money mentor. This was my father. He retired at the age of 40 years old. He was a successful entrepreneur himself, a savvy, prudent businessman. But he admittedly would say that he spent his whole life trading time for money. And I remember that about my dad. My dad worked incredibly hard. He worked long hours. We worked on Saturdays. I say we because I was there too, even as a young kid. But here's the thing: at the age of 55, my dad passed away due to a sudden stroke. I was 21 years old. My brother was senior year of high school, and my dad passed away from a stroke. And what I remember most about as I look back at those 15 years of his retirement that he got from 40 to 55 was just how much my dad still worried about money. And as I reflect on his story, as I kind of reflect back on that, looking back, here's what I realized about my dad. My dad was incredible at making money. Like, he knew how to hustle to make money. I feel like a lot of us have enough ingenuity, have enough creativity that we know how to go make money if our back's against the wall. My dad knew how to do that, but what my dad didn't know how to do was multiply his money into retirement. So that worry of, hey, I know how to make it, but I don't really know how to sustain it or multiply it, it made him frugal, it made him stressed, and it kept him from being as generous as I'm sure my dad wished he could have been. And so this is really where my investing journey begins. My father passed away, and he left me and my brother with $147,000. And depending on, you know, where you come from in your story, that may be a little bit or a lot of money. I guess I'd ask it to you this way: if you worked your entire life, and you only had $147,000 left to give, would you be satisfied with that? So I was left, we were left with this. And like many Americans, I mean, that was a lot for me at 21 years old. I had no idea what to do with this money. So what do I do? Like most people, I trust a financial advisor. Okay. And traditional wealth building advice tells us to do what? Let's put that money away for 40 years. Let's wait for retirement. Don't touch it. Don't worry about it. Let it grow. Okay, let's do that. And then this happened. So I go spend the next 6 years serving as a college pastor. That was my calling. That was my vocation. I love getting to share the love of God with folks who are in need, with folks who are curious, who have a passion to impact the world. And there's no greater place on the planet, in my opinion, of ambition and entrepreneurship and exploration than the college campus. And I absolutely love my time there. But one day, this is what happened. This is where I would say my entire mission changed. Is I was serving about 4 years into our ministry. We were a nonprofit, donor-based nonprofit. So we were raising all the funds we needed to run this organization. And we were hiring young college students who had graduated and coming on our team. And they were beginning to raise support. And about 4 years into that ministry, as we were really growing it, one of the young men came to me and said, Ellis, I don't have enough money this month to buy groceries. And I would just say like that changed everything I thought about life, the world, my mission, because here was a guy who loved God, who loved people, who was on a mission to help other people live a better life. And the one thing he needed in that moment was the one thing I didn't really know anything about, was money. And so I made a decision in that moment, honestly, with not a whole lot of like direction on what to do. I just made a decision. I'm going to learn about how to make and multiply money in my life so that I'm never in a position like this where I can't give. And so that's exactly what I did. I learned how to make it, how to multiply it, and ultimately how to make that money matter, right? Because now once we have it, we can sow it back into things that we're really passionate about. And so here's what I did. So I started and said, okay, well, what makes sense? Like, what do I do now? I made a decision. What do I do? Well, I thought the most common sense thing was like, let's just go back to where the little bit of money I have was. Like, this guy's a financial advisor. Maybe, he could show me some stuff. And I was hopeful that because I followed the traditional wealth building advice, like my money had grown, right? But here's what I found out. And here's what a lot of folks find out, unfortunately, too late, is that even though they followed the traditional wealth building advice, even though they did the smart thing of what has been working maybe for the last 2 decades, unfortunately now nothing has changed. Like my money had not changed. It had not grown. And I know that there are millions of Americans who can relate to this story today. Honestly, it breaks my heart that there's that much money sitting in retirement accounts that Scott was talking about, because I know that they're getting charged with fees that they've never asked about. They don't know their fees. They don't know their growth. And it's because I fell for the 2 lies of the financial wealth building sector that I think most people are falling for today. And here's what I want to give to you. Lie number 1, or myth number 1, is sit it and forget it. Because I know this about being an entrepreneur, being a business owner. If you don't measure it, it does not grow. Right? And so this myth of sit it and forget it is not to benefit you. It's to benefit Wall Street. Why? Because the longer you can stop paying attention, the more they can earn their fees. Let that sink in for a minute. If you're not paying attention to it, they can keep earning their fees, because they make their fees no matter how well your investment does. So I love the private sector, because we can be much more aligned in our incentive together. And then the myth number 2 is this: what worked for my parents will work for me. What worked for my parents will work for me. It's just not true today. Why? Because the target is always moving. It's impossible to plan for retirement. Why? Because what was enough for retirement, even if you look at, heck, go before COVID. What was enough before COVID is no longer enough today, because if you push that out 20 years and you've printed 4 times the money supply, and you think about inflation, what that does to a retirement account over 20, 30, 40 years, guys, if the target is always moving, then it makes it impossible to actually know what you need for retirement, where in the past that was not the case. And so what this meant for me is that my investing strategy back then was based on hope. I just hope that it grows fast enough. But that meant I was heading down the same path of all my money mentors: average results, average wealth, average life. And I knew if I didn't begin to take radically different actions than those around me, there would be nobody else to blame but myself. Is there anybody that can relate to this today? Like if that's you, just say, man, like this is hitting. Like if you know you have to take responsibility today, just say me. Like, I know I need to take responsibility for my family, for my results. Like, if you're one saying, I'm not going to give the responsibility of my wealth or my dollars to somebody else. You would not do that for your kids. You're not going to get to heaven and God's going to say, well, hey, how'd you do with your kids? You're not going to say, well, I gave them to a babysitter. Let's ask them. Still your responsibility. Same is true with your wealth in your dollars. That's why I'm really passionate about this today, and I'm excited to give you this this teaching. And so a lot has changed for me. This is my family, or we have also a 4-month-old boy who is not present at this time. We picked a better vehicle. I found better mentors. And honestly, these decisions have changed my life forever. That's us getting to travel to New York and go to a Yankees game, and just a really sweet day. One of my favorite days with our family. My daughter Ruthie there was actually born on Babe Ruth Day. Bonus points if anybody in the chat knows what day Babe Ruth Day is. If not, you can look it up, and that is my daughter's birthday. So a lot has changed since then. We built a very high 6-figure online education company. So that was kind of how we learned how to make money. We purchased, like I said, more than $150 million of commercial real estate. Here are a couple of our deals that we bought in the multifamily space. I was named 2020 Investor of the Year. My wife and I started our family. She's had the ability to quit her job. And like I said, we've helped more than 100 investors multiply their money and start their journey towards financial freedom.
Ellis, I'm going to jump in with a quick question. You said there just that last slide, you've worked with so many different people over the years and helping them achieve financial freedom and whatnot. What would you say is the biggest hurdle? You mentioned the 2 myths, obviously, that people you have to overcome. Not doing what your parents did, and not just trusting the set it and forget it method. What do you think is the biggest hurdle that you've seen with individual investors that they have to overcome, either in their mindset or what they're doing? That's allowed the people that you've seen be successful with multiplying their money. What have they done? What's the common thread with those individuals? Maybe something you haven't said yet.
Yeah, I remember. I'll tell you a quick story. Calling one of my, it was actually a family member of mine, and we, on a deal, and I was like, hey, here are the returns. Here's a great asset, like, it's cash, like, all the great things about real estate provides. And he said, hey, man, it probably is a good deal. And I probably will make a lot of money with you, but listen, I've been investing with my financial advisor for 30 years, and honestly, like, I just don't pay attention to that. Like, I just don't, like, that's his job. And that's when it hit me, like, most people are just like, it's one of 2 things. It's either apathy, Scott, of just like, hey, they feel their role is just to make it, and someone else needs to be the one to kind of think about multiplying it. So they're just apathetic in the way that they want to invest. That's why maybe only 4% self-direct their money, because just assume someone else is going to do it for them. The other thing is just fear. Like, okay, if I'm not investing with the financial advisor, or some of my money's not with, like, who do I trust? And I know a lot of people, especially people with money, who know alternative assets are better, who know private in the, there's liquidity in the public markets, but there's wealth in the private markets. Guys that understand that at a high level, the thing that maybe keeps them from going is just like, who do I trust with this? Because they've worked so hard to get their money that they're very fearful about losing it now. And so it's overcoming kind of that trust barrier, that fear of, like, actually investing it into an asset that is going to, work as hard for their money as they did. Those are probably the 2 things I see the most.
Okay, thanks. Yeah, continue on, Ellis. And again, anyone has any questions for Ellis as you go along, make sure you get those typed in the question box.
Yeah. Hit me up, guys. Make this hard on me. All right. So how does this apply to you? Cool for you, Ellis, but how does this apply to you? Well, I know that you want options. Okay. So ask yourself the question of knowing how to just make money and not multiply it will get you the results you want in life. Just ask yourself that question. because typically we realize this later in life when it's too late. And I know if you're on this call, you got time. Like, you have time. I can tell you so many stories of guys in their 50s and 60s, you know, being able to build significant wealth in their lifetime through alternative investments. Because your current vehicle, your 401k, your IRA, your traditional advice, it will never get you the results you dream of. And the way that I know that is just look around, guys. Look around. And so, nothing's going to change if you don't begin to take wildly different actions. That's really the biggest point I want to share with you today. This is my buddy Chris Underwood, 38th winner of the Survivor TV show. Any Survivor fans? He won $1 million in cash prize. I think after taxes, he said he took home about 600 of that. He's a top solar sales manager as well. And he said, I'd rather scale my income and invest in real estate that's turnkey and managed by a world-class team, a portion of my net worth parked in long-term appreciating assets like multifamily is the perfect diversification for where I'm at in life. So here's what I would typically cover. But as I was thinking about this crowd, I was like, you know what? I don't think they just need a master class on real estate. I really want to back up a little bit and understand about multiplying money. And so here's what we're going to cover instead. I have a brand new presentation. I want to provide you with a very simple framework that anyone can follow in order to grow wealth faster. Okay. And that framework, and this is also where we depart from the nice slides. Okay. Because like, I really wanted to give you something unique today. And so this is what I call the Think Wealthy formula. And it's very simple. It's so anyone can follow it. The first step is to make it. The second step is to keep it. The third step is to multiply it. And so ultimately that we can make it matter. And so that's what I want to just review with you today over the next 15 minutes or so about these steps of make it, keep it, multiply it, making it matter. And if we have time, ask a few questions. If not, I'll give you a chance to schedule a call with me directly for those who are here live today. Okay, so let's jump into this. Scott, we still doing okay, man? Ready to roll?
We're doing fine. Absolutely.
All right, guys. If you're with me here, put yes in the chat. Would love to see some interaction, just so I know that you're with me, that you're enjoying this presentation and ready to move on. So here's the first one: make it. And I'll tell you a quick story. I was with my father-in-law just a few weeks ago. We got to go to Colorado and do some fly fishing. And my father-in-law has been served as a pastor for several decades. A really brilliant man, has counseled many folks. Is very well educated. He's just a great advisor. He's think about the value that he's built, the people skills he's built in 30, 40 years of ministry, of counseling, of therapy, of working through hard times with people. And we were having this conversation, you know, as retirement is somewhat on the horizon for him, right? At some point in this decade. And he's like, you know, he kind of said something like he assumed, and I'm not going to go into the whole conversation, but he assumed that his income would be limited in retirement. He's like, well, you know, there's some things we won't be able to do because my income's going to be, you know, fixed. And and so I heard what he said, and the next day I came to him and said, you know, it's really interesting that you just assumed yesterday that your income in retirement is going to be less than it is today. And he said, well, what do you mean? I said, well, in my world, the world of entrepreneurship, and in the society that I live in, the capitalistic society, which by the way is the same society that you live in as well, what I know to be true is that money is not tied to the amount of hours that you work. The amount of money that you make is tied to the amount of value that you bring into the world. And dude, what I know about you, I didn't call him dude. Okay, sir, it's probably what I call my father-in-law. No, we have a very good relationship. I said, you know, his name is Steve. Steve, what I know about you is that you are a man of tremendous value, and you can bring tremendous value to the world. And I think that if you were just to change your thinking a little bit, that you probably could make a lot more money in retirement because of the value that you can bring to the world. And here's my point today, guys. In a capitalist society, money is tied to one thing. It's tied to value. And many of you have spent a lifetime acquiring skills and knowledge that the marketplace wants. And unlike sports, right, you can play business well into retirement years. And so I just like to help people think differently about making money, even if you have a 9 to 5. right? There's likely ways that you can bring value outside of your 9 to 5 in order to make more money, because without income, it's really impossible to build more wealth. So the first thing is income, or making. It's the only thing nugget I want to give you today is maybe open your mind a little bit to the idea that money is tied to value and not necessarily time. The second point of my formula is to keep it, okay? And here are the 3 wealth killers that kill us in terms of our wealth building journey. Three things. I used to say 2, but now that I've witnessed the third many times, I realized how big the third one is as well. So taxes, fees, and divorce. And I'm not going to get into all 3 of these today. I'm going to talk about one of these today. I'm going to talk about taxes. The one thing I'll say about fees is do you even know what fees your advisor is charging you? Do you even know on your retirement accounts what fees they're charging you? That's why I like Advanta. I know their fee structure. It's very simple. It's very straightforward. Have you asked your other company? Have you asked your 401k company what the fees are on that? Most folks don't know the fees that they're being charged. And the third is just divorce. I know this, that it's really hard to be mad at someone that you do a weekly date night with and that you hug for 10 seconds a day. And so I just would say, in order to lower the divorce rate on this call today, one thing my wife and I do is we just, this might sound weird, but we touch each other every day. Like, how foreign is that? Like, we give each other a long hug and we pause. Because even though life's happening, and even though, we're stressed out about our kids and all this thing is happening, we know that this is the one thing that matters, our marriage. And so just take a minute today, hug your spouse, and awkwardly hold it for 10 seconds today. Just try it. It's actually scientifically proven that there's a chemical released in your brain. I believe the chemical is called serotonin, that if you hold that hug for longer than 5 seconds, somewhere between 8 and 10 seconds, that it actually releases a chemical in your brain that makes you more happy. Fascinating. Try it. All right, enough marriage counseling today. Let's talk about money. So never ever pay taxes. All right, so if you haven't, I like telling stories. So let me tell you another story to show you this point. So last summer, I'm with my in-laws. A lot of stories about my in-laws. I don't anyways, not gonna get into that. But I'm planning a family game night with my in-laws. And it wasn't Monopoly, but it was a game similar to Monopoly. And before we started, I took out the time to read. I'd never played the game, so I said, hey, let me read the rules to this game. Like, I didn't, it's a family competitive game. I'm like, I better know the rules before I start playing the game. Well, no one else took time to read the rules, okay? I just said, hey, I've never played. They all assumed they knew the rules, so I said, let me read the rule book. So as the game progressed, here's what began to happen. I started to gain what seemed like a very unfair advantage on the game. However, like, I was just simply following the rules that no one else had managed to read. And so this is a family game, okay? And so here's what began to happen, which I found so fascinating as like a sociological experience. I was first accused of cheating. Wow. I'm just following the rules, I thought. So I'm like, okay, I'm not cheating. I'm reading the rules. I felt fine. And then my family proceeded to make up their own rules to disadvantage me because my advantage was so unfair. They're like, oh, no, you can't do that. You have to do this instead. I'm like, that is not what the rules say. However, we all had the same rules from the beginning. And the reason I shared this story with you is because this what happens every day in our society. Just look at some of these headlines of what the government is doing to those who read the rule book and who seem to have an unfair advantage when it comes to their wealth. How the ultra wealthy devise ways to not pay their share of taxes. Oh, you're cheating. You're not paying taxes. You're devising ways to not pay your share. Richest Americans pay almost no income taxes, report finds. A report from ProPublica illustrated how wealthy people in the U.S. are able to avoid income taxes by keeping the bulk of their wealth in investments that have little or no taxes. Like, it almost makes it seem like these folks are doing something wrong when the headline itself says there are investments that everybody can have that have little or no taxes. Really interesting, right? You're cheating first. And then when that's not enough, they're going to start devising strategies against you. So Biden calls for new taxes on the wealthy. Taxes by keeping the bulk. So this is a new thing Biden wants to do. Biden's better plan to tax the rich. His budget proposes a levy on unrealized capital gains for high net worth households. So because we can't get access to your money because you're following the rules by owning assets, we're going to start taxing your unrealized capital gains. I want to start devising new ways to come after your wealth. So, guys, the reason I show this to you is because there is a way to actually avoid taxes. Now, can we control some of these government forces? We're not here to get into that today, but you should know and look into this as you're voting in the election coming up. However, what I want you to know, guys, is that the rule book was written by landowners for landowners. And if you want to win the game, you own real estate, plain and simple. And so this is just a K1. I just want to show you an example real quick. This is a previous K1. I invested $100,000 in this deal, okay, into a cash flowing property. On paper, I lost almost $70,000. So I invested 100. On paper, I lost almost $70,000 in the first year. And you're like, actually, look at this. This was the beginning of September 2021. In December of 2021, I on paper lost $70,000. You might be thinking, Ellis, you might be the worst investor on the planet. Well, what if I told you that, however, this deal pays me every single month, and that even though because of it's a real estate, I get the benefit from the write-offs. So I get the benefit from the depreciation, bonus depreciation, property and mortgage expenses. All of these result in tax-free income. And so that's really, really important for you to know, is that why, again, this is the rules of the game that we all get to play by. And if you don't know these rules, it's worth diving into them. Let me think about what I want to make sure I'm focus on my time here. I'm going to skip through this. Strategy number 2 about refinances. This is a way we can refinance, take the loan proceeds that are non-taxable. I do want to quickly talk about, here's another strategy that you can look into is real estate professional status. It's a status that enables you to convert otherwise passive losses to deductible ordinary losses, which means you could lower your tax bill down to $0. So, this is how you qualify a real estate professional. This may not be something, I always tell my clients and investors this may not be a strategy that you can do tomorrow or this tax year, but it is absolutely worth looking into how to accomplish this over the next 5 to 10 years. Because if you or your wife or spouse can figure out how to do this, really, really key. And this can make you a lot of money by helping you not dish out a lot of money in taxes. And so here are a couple of different examples of real estate professionals. The nice thing is if you're married, you can file jointly, so your spouse can qualify as a real estate professional. This is really, really massive. Bottom line, consider this a 5 to 10 year strategy. $1 million of savings is worth looking into. And reality is, Trump paid no federal income taxes in the 10 of past 15 years is because he is a real estate professional and he's leveraging a lot of this. All right. So guys, however, this is not just for the ultra wealthy, this strategy. This is an investor of mine, Keith Maurer. He's a New Mexico real estate broker. He says, in my case, I'm looking to use accelerated appreciation to offset income by getting a K1 that shows losses for the year that offsets some of the income that I have. Another one of my investors, an oil and gas attorney, he owns mineral rights, so they get income from the mineral rights, and they invest in real estate and use the depreciation off the real estate to offset the passive income taxes from his mineral rights. So again, there are great strategies we can begin to combine when we start to look at the alternative investment space. Lastly, I want to talk about more.
Ellis, if I can, I was going to jump in. I had a couple of quick questions that pop up, I think, on what you were just talking about, then we can get into the multiplying stuff. But it's
sure.
Someone asked, like, if you're inside an IRA account, the real estate and professional status doesn't matter with the deductions and depreciation. And that's correct. For the most part, your IRA doesn't get those benefits, depending on what your investments are. But I think, again, the presentation is kind of geared not just IRA, but you're correct in that question, someone asked, an IRA, within the IRA, that doesn't matter what your personal status is. So really, that would be more of a question for for you as an individual. Someone asked though a question for you, Ellis. I know the answer to this,
Real
but
quick,
I'll
just to clarify for that person, they still get a K1 though, meaning like the losses are still theirs to use. Is that correct?
correct. Yeah, if you have loss, well, if you get a loss with inside of an IRA investment, if your IRA is subject to something called unrelated business income tax or UBIT, which can apply to some leveraged real estate investments or some other. If you're invested in an ongoing business, yeah, your IRA can potentially use those losses. That is a factor on the K1. Now, I don't know if that would be available to an IRA as an REP type deductions, but certainly as an investor in a syndication or in a business or whatever, yes, if you get losses, the IRA may be able to take advantage of those. So definitely
Well, and I
something
even
to
was
look
wondering
into.
too, and we don't maybe have time to this, but can they take those losses against an investment outside of this one, right? That they're, because they're getting the losses, or can that only be applied to that because it's through an
Yeah,
IRA? That's a question I
yeah,
actually don't know the answer to. It's a
yeah.
good question.
Yeah, it can only be done through the IRA. So yeah, if an IRA is getting losses or depreciation, it has to be used against any tax that the IRA itself might be subject to. So yeah, we wouldn't be able to use it personally, and vice versa. Personal losses cannot be then transferred into the IRA. So they do have to remain separate for that.
Got it.
Again, one other question before we move on, and you just mentioned it as well. I'll let you answer it. Somebody asked, what is a K1? Kind of a
Yeah,
simple tax standpoint, simple
great.
tax.
And by the way, like, yeah, this is, I love these questions. Oh, I can't use it in my self-directed IRA. Well, the fact that you even know what a self-directed IRA is and you're not being taxed on the income because you're investing via self-directed IRA is another great vehicle, right? So it's again, there are just strategies to employ, and not everything is so cookie cutter, right? And so if you can use a self-directed IRA for some of your stuff, that's a great path. Now, but not everything. Like your self-directed IRA doesn't have all of your money. So then you can employ both strategies. So I think it's just important and helpful to be like, hey, this is not and or here. Or it's not one or the other. It's let's deploy a several of these strategies to help you multiply wealth over your lifetime. Is kind of what I'm sharing here. So for those of you who are using self-directed IRAs, you're already a step ahead in some of this. What is a K1? This is it's essentially what is distributed to every investor at the end of the year. It just shows your ownership in the entity. It is a tax filing that it's a piece of paper really that you give to your CPA or that you give to the IRA that shows your investment in this deal. It shows your losses in this deal, and really, it's different. You're not going to get this in like a REIT, or you're not going to get this per se in a stock investment. This shows your shares of the asset, because you are unlike a REIT, you are a true owner in this deal. You own ownership shares in this investment. Therefore, the ownership benefits like write-offs, depreciation, mortgage expense, all that stuff, right, is coming back to you as the investor. And so a K1 is able to show that it's what you give to your CPA or the IRA at the end of the year, and shows that amount of total loss or total income on the deal. And so that's what that is. And typically you're getting that in a syndication or some type of direct investment. All right. So
thanks, Ellis. Yeah, let's roll through it. And if anyone has any other questions, get them in, and we'll get to those questions at the end of the presentation.
Yeah, I'm excited about this one because I feel like this is something I did not understand at the beginning of my career. And I feel like most of my investors now, even though let me show you what I mean, because I think this is so helpful. There are two types of investors. And I feel like even if you are the type I want to talk about today, you may not even realize it. And it's hurting your investments. It's hurting your portfolio. So I say there are two types of investors, and I love this meme. Which type are you? And if you I don't have to say anything, right? So if you're one or the other, how much it bothers you. If you're one of the ones that squeeze from the bottom versus squeeze in the middle, it drives you insane. Okay, talking about divorce, maybe we can lower the divorce rate by just getting on the same page here about how to use a toothpaste tube. Okay, so really important that you ask your significant other, which way they prefer, or maybe you need to teach them your method of doing things if you're the one who squeezes from the bottom. But in all seriousness, there's two types of investors, and the two are this: it's those who make their money from their business, and it's those who need to make their money from their investments. Very, very different type of investor. Those who make their money from their business or maybe high salary job, and those who need to make their money from their investments. Because if you make your money from your investments, meaning like you're reliant on your investments to do the bulk of your wealth building, you inherently have to take on more risk. And so it's no wonder why many people have been lured toward the promises of crypto, NFTs, meme stocks, right? Because they promise these outsized returns over a much shorter period of time. And of course that's attracted to people because, hey, if I don't have to, I can't make more in my job, or my job is limited, my income is limited, I have to kind of go find new ways to make more money, then of course these things are going to draw more people in. But guys, I don't know if you've read this book, great book, Timeless Lessons on Wealth, Greed, and Happiness. And this is the most important lesson I got out of this book, which I think really relates to us today, is that the key to sustainable wealth multiplication is to make the most amount of money for the longest amount of time. And I feel like that second part has been lost in translation over the last few years. Let's just go make the most amount of money. No, that's not how you build real sustainable wealth. It's how we make the most amount of money for the longest amount of time. And so let me just show you this example, guys. What I mean is so we want the most amount of money with the greatest predictability, right, of being profitable over the longest amount of time. So where does an NFT fall? Well, probably 0% predictability. Bitcoin, well, depending on how long you hold Bitcoin, it probably can make you a lot of money. But the reality is you just don't know. The predictability of Bitcoin, of crypto, is so far to the left that we just don't know if it's even going to be in use in a few years. The S&P 500, right, over a long period of time will make decent money, right? If you hold it over a long period of time, it's shown to make somewhere between 7 and 9%. However, guys, commercial real estate historically has been proven over a long period of time to be the most predictable asset to make you the most amount of money. And that is why I think they say liquidity is built in the public markets, but wealth is built in the private markets. And so I'm not going to dive. This is not a real estate masterclass today, but there's just one or two things I want to tell you about as you seek to get into the private space and you're looking at real estate deals. As I say, you need to know this, guys. The number one thing most investors don't understand about real estate is very simple: as debt. And the best example I can give to you this is look at 08 and 09. And honestly, you're going to be able to say, look at 23 and 24 here soon. Where did all the real estate go in 08 and 09? Well, if you drive down all the streets, the real estate is still there. The houses, the assets are still there. What people lost was their equity, their shirt, right? Their livelihood. Why? Because they underestimated the debt cycle. And they're playing a short-term game in a long-term asset. And so I would just say the biggest mistake most of my clients are making before they meet me is they are making a 3-year bet when they're really looking for a 10 to 20-year investment. And so that's all I want to say on that is you need to be careful, especially in this day and age, of the type of debt and finance product that's on the asset, because that makes all the difference. And I'm not saying you can't use you'll only use long-term debt. No, that's not what I mean. But it's important to understand the risk you're taking, the investment type you're making, not just on the asset itself, but the finance vehicle that's holding it. And I'm just telling you how massively important that is for us today when we kind of live in a credit world, and most of the assets you're investing in are backed by some type of debt. And so it is one of the things that I've sensed and seen being overlooked in this real estate cycle, in this market cycle, and is going to hurt a lot of people because of that. And so I just giving that to you today because it's very serious and it's something that we pay a lot of attention to today. And so guys, here's what we covered: the think wealthy formula, how to make it, keep it, multiply it. Money is tied to value. Remember that as you're thinking about, well, how do I make more money? Well, think about value. If you want to win the game, own real estate, invest in your marriage, take that 10-second hug today. 2 types of investors: be the one who makes money and owns assets. Guys, I just want to end with this. The real thief of my dad's retirement, is as hard as this was not his stroke. It was his worry. And because my dad did have really, he had 15 years. And even though that was cut short, there were a lot of really good things that happened in those 15 years. But what I remember a lot was that my dad was just worried. It's because he needed a money mentor to help him create a blueprint. He needed someone to provide connections and alternative opportunities that would give him confidence throughout retirement instead of always trying to just hope or guess on what he would do. And so this is what I'm passionate about as a benefit, as a thank you to Scott and Advanta. I don't typically take all of our calls, but I will give a personalized strategy call to anyone who is here today or watching this replay this week. You can scan this link right here, and this will take you to my personal calendar. I will do a one-on-one investor blueprint call with anybody who would like to do that. Let me just say my availability will fill up, not just because of my schedule, but because I'm sure folks will take advantage of this. And so if you're interested in this, I'll leave this up for a minute or two to go ahead and scan this. And if you this is a QR code, so you pull out the camera on your phone, then you can do this. But if you want a personalized strategy call, scan this QR code right now. If you're on your phone, and that's going to be very difficult, then go to symphonycapitalgroup.com. And if you click the invest, that will take you to a call schedule with us as well. And if I see that come in today, I'll make sure that gets moved over. So you can also book a call there. Symphonycapitalgroup.com /schedule is another way to do that. Symphonycapitalgroup.com /schedule. Or you can just send me an email for this link, ellis@symphonycapitalgroup.com, and I will honor that. So would love to do that with anyone who's listening today. I look forward to getting to meet many of you. Like I said, big fan of Advanta and grateful to be here today. So Scott, that's all I got for today, man. I hope that was helpful, and happy to take a few questions if I got a few more minutes.
Yeah, great. Yeah, we have a couple minutes. Thanks. I really appreciate the presentation. Like I said, a little bit different than some of what we usually do on our calls. That was refreshing to get kind of a different take on things. Just a couple questions came in. Somebody asked how we contact you. You got that QR code right there on the screen. I'll answer that question. Someone asked, so is money made mostly from stocks? And what I'm taking away from your presentation, no, it's long-term wealth and accumulation. It's real estate has been one of the strongest industries to get invested in from that standpoint. You can make money from stocks, but it's also, I saw a presentation a long time ago that the average stock return is 7 or 8% a year, but that's over a 90-year period. So depending on when you get in and when you get out is going to ultimately determine whether or not you're successful. And that's the downside of trying to time a market as opposed to finding a real estate investment that's going to appreciate long-term and give you cash flow in the interim. So not sure what thoughts you have for that question.
I mean, I would say most wealth is built in the first step of my formula is to make money. Like, you can't build wealth without income. And most folks build their wealth through some type of income generating activity. Some of that can be through real estate. If you treat that as your income generating activity. But you build it, sustain it, you multiply it through assets, like the stock market, yes, like real estate, right? Yes, like businesses. So when I look at the folks I've studied and how people really get there, honestly, it's through private ownership, right? It's through value creation through some type of business or income generating activity. And like I said, that could be real estate, right? If you treat real estate like that type of activity, I think what we're talking about today is probably not that, but it is the way to sustain and multiply that capital over your lifetime.
Yeah, and another question we had came up, said, in your opinion, how much of a portfolio should be self-directed? I guess we're talking about IRA specifically. or not, or maybe even just, in general, if someone has both IRA and non-IRA assets, what kind of, do you have a metric that you go by, or a suggestion for someone else who's looking at what, for alternative assets, how much of your portfolio should be in that versus kind of conventional assets?
I mean, not to give my, I don't know, I would just say 100% for me. I mean, I would say this, everything for me is self-directed in the sense that I know where all of my money is. I don't own mutual funds, okay, because I don't know where my money is. I can't pay attention to it. I don't know how those companies are doing. So I do own a few stocks that I like, stock companies that I believe in, that are cash flowing, that meet all my metrics for an investment, that what I would consider an asset pays its liabilities from cash flow. So how many stocks, how many companies are invested in companies that, one, don't even meet the definition of an asset? A lot. So again, when you say how much of your portfolio, in my opinion, I think it's 100% in the sense that you should know where all of your money is. And then, when if you agree with that, then we can figure out kind of where your competency is, what you understand the most. And I would say that 80-20 rule is 80% of your money should be in things that you understand. And the other 20%, honestly, is probably a mix of cash and a mix of kind of high risk stuff. Like, hey, I want to take a chance on this. I like it. I believe in the mission. I like the owner, whatever it is. You can take a chance with some of that. But 80%, in my opinion, should be in an area where you're competent, should be in an area where you understand, so that, you can see what's going on. And even if you're not like the expert real estate investor, it's something that you can begin to understand over a short amount of time and get better at it as you invest more into it. And so that's typically the rule that I'm kind of, encouraging folks to do, is 100%, you should know where 100% of your money is. And then, 80% of that should be in a core competency. And then 20%, I think, is cash or other risky stuff. Like if you like crypto, right? If you want to own crypto, or you want to take an entrepreneurial kind of risk at something, that's what I would recommend.
All right, well, cool. Ellis, again, thanks for your time. Last question was someone to ask about the typical minimum investment in one of your projects. I think that's a great thing to just connect with you one-on-one on, or a strategy call
it varies.
with Symphony Capital
It
Group.
varies.
So.
We typically, we have investment opportunities mainly for accredited investors, but we'll on occasion also invest with, or also open up stuff for non-accredited investors. And but listen, like I said, the point is, the investor blueprint call is not a sales thing. It really is to help you. And so if you just take me up on that, I'd be happy to recommend other stuff, even if we can't help you, is the goal there. And so our minimum is typically 6 figures, but I'm happy to, make as many recommendations and references as need be.
Okay, Ellis, again, thank you very much for your time. Thank you, everybody, for who has attended live, and I'm certainly, there's plenty of people who are viewing this and going to review the recording on it. So if you have any questions really about self-directed IRAs, you can certainly reach out to me. Here's my contact information on this screen. Reach out. Like I said, self-directed questions. Do you have other questions for Ellis? He had put his information up there on the one of his last slides. Everyone who's listening live will get a recording of this webinar, an email in a day or so. So you'll have that link there again, or you can reach him at Ellis at symphonycapitalgroup.com. So Ellis, thank you again for coming on today.
Thanks, Scott. Everybody have a great Tuesday.
Thank you. Thanks very much. And thanks again, everyone, for listening live. We'll see you at our next webinar.